Welcome to the Capital News. I am your host, Alex Karitis. Today is April 29th, 2019. Thank you so much for joining me. I hope everyone enjoyed their weekend. So what happened with the stock market today? Well, the S&P closed up 3, the Dow was up 11, NASDAQ was up 15, and the Russell 2000, the small cap index, closed up for the day 6.5 points. NASDAQ and S&P continue to make all-time highs. The Dow is still lingering. It's just a couple hundred points away from making all-time highs. So again, any day we could be there. And the Russell 2000 is still, 100 plus points away, almost a couple hundred points away from its all-time highs of last year. Oil is now at $63.38 a barrel. Meanwhile, Brent, the European market, is now slightly below $72. So there has been a little bit of a retreat in price with the oil markets as of late. Of course, our fearless leader, President Donald Trump, got on the phone, yelled at OPEC, particularly Saudi Arabia. They said, yeah, we'll calm it down here. I think they're just saying that just to appease them. But nevertheless, headlines moved this market. And the other day when that happened, the markets did go to the downside when it came to oil. Now, again, here at the Capital News, we do anticipate over the longer term, barring some sort of geopolitical event, that just given the supply and demand functionality of everything, that oil prices will be headed lower. That's not to say it's going to happen tomorrow. It's not going to be anything drastic, but net, that's where it's likely headed. Gold and silver. Well, gold is still below $1,300 an ounce. Again, that's our benchmark that we're looking for. However, it still made a little bit of a comeback. It's now at $1,284 an ounce. Meanwhile, silver is just slightly below 15 and now sits at $14.98. The Treasury market, well, if we're looking at the U.S. 10-year Treasury, it increased nearly 1.25 percentage point today and now sits at 2.536%. So there was some selling in the bond market. So are we starting to see a rotation out of bonds into stocks? Where's this money going, folks? Is the melt up underway? Is that what we are going to start seeing? Are the retail investors, mom and pop, the average Joe, are they going to start getting in when the market is making record highs? Again, you're supposed to buy low, sell high, so why is everybody getting in at the top? Or does this thing have a lot more room to go? We're in the financial world of Oz. Your guess is as good as the next guy's. Again, we're not here to predict what happens in the markets day to day. It's about coming up with a plan. It's about giving you guys the other side of the story, because if you're watching the mainstream financial media, whether that's Bloomberg, Fox Business, CNBC, or any others out there, it's really just hype everything up, that everything's fine, it's the bull market, buy, there's no need to worry. Anything that's bad news, it's already been discounted, it's priced in already, you don't have to worry about a thing, just go ahead and buy and don't worry about it, we'll take care of everything. Well, there's another side to that story. It doesn't mean that they're right or wrong, doesn't mean that I'm right or wrong, but you have to have the full picture. Everybody knows what's being said out there from the White House on down, the banks, everybody. What they don't tell you is the stuff that we talk about here every single day. Why? Because it doesn't fit their narrative. It's counter to their narrative. We're just interested in the truth here. We just want the full picture. I just happen to be of the mindset that diminishing marginal returns on all of this quantitative easing, low interest rates, printing of the funny money is coming to an end. I don't have a crystal ball. I can't give you an exact date. All I can do is tell you that it's coming. That I do know. When, again, is the ultimate question. If I knew, I'd tell you, you could bet the farm. But I don't know. That's why you have to have a plan. That's why you have to be diversified. That's why you have to have some cash sitting on the sidelines, waiting for this massive correction, because then you can go shopping for the sell of a lifetime. Because any company that remains standing after what I believe is going to happen in the not-too-distant future, well, my goodness, they're here for a good while anyways, because if they can take the beating that's coming and still continue to produce and operate, well, then those are the companies that you want to own. So you have to be positioned to take advantage of that. It doesn't mean you're going to necessarily have to time this market or have positions where you make money on the downside, but at least be there waiting in the wings when this thing does sell off. Remember, when there's blood in the street, you buy real estate. Be fearful when others are greedy. Be greedy when others are fearful, okay? That's how you want to do it. It's contrary, it's counterintuitive sometimes, but look, most people buy high, sell low. That's the exact opposite of what you're supposed to do. Stay focused, stay in there, and we're going to keep talking about all this stuff because it's really an interesting time to be alive because these markets, no ifs, ands, or buts about it, they're fixed one way or another. The types of motions that we are seeing in these markets, a lot of it just doesn't seem to be random. Something's happening in the middle of the day, at the end of the day, the last hour, 30 minutes of trading. There's a rush to come into the market, although today it was the opposite. There was actually a rush out of the market, and there was a sell-off at the end of the market. So I don't know if that's going to be a new trend. Again, one day does not make a trend, but it's something to pay attention to, and that's exactly what we're going to do here. Now, last week on Friday, we had, the first quarter GDP numbers come out, and, well, they were a blockbuster. I mean, especially for the White House, President Trump, his economic team, most assuredly Larry Kudlow, because he was out there making the rounds on TV, of course, saying everything is fine, everything is fantastic, because you have to understand, folks, that the consensus, we were looking at 2.2, 2.3% first quarter GDP. Well, we came in at 3.2%. So basically a full percentage point to the upside, which just really surprised everybody, because you remember our conversations early on when we started this podcast back in February, that there was a lot of downward revisions to GDP, especially following the stock market correction in bear market territory in late 2018. So there was a lot of people speculating, okay, what's the market doing? Is it predicting an oncoming recession? Is everything going to start slowing down? And then everybody starts lowering their expectations for company earnings, which, again, we are still in the midst of the earnings season for the first quarter for most companies. But also, there were revisions to the downside for GDP, gross domestic product. Now, they have been revised to the upside, but they only made it to, again, 2.2, 2.3%. That was the consensus of everybody out there on the street. And we get a whopping 3.2%. However, when you look at the numbers, something just doesn't smell right to me. It's a little fishy. What do I mean by this? Well, one of the major contributing factors to this surprise to the upside was an increase in inventory. So there was, again, another inventory build. All right? But at the same time, we also had a decrease in net exports. So there was actually a decrease in imports. Okay, so I should actually say there was an increase in net exports because there was fewer imports coming into the country. All right. Now, what's fishy to me in regards to this GDP report, again, goes right back to the inventory build. You build inventory in a couple of ways. You either import more goods and you stock them on your shelves and you hope that the customers are there and then you make a sell, or you produce more. Well, we know from the GDP report that imports decreased. So we can't attribute the rise of these inventories to an increase in imports because it was quite the opposite. We know through previous discussions that we have had here on this podcast, the vast majority of production numbers that have been released during this first quarter have been stagnant or to the downside. So production has not increased. So how are these inventories being built? Crickets. I know. What's the answer? What's going on? Is this a seasonality glitch? What's going to be the revised numbers when it comes out in a month? I mean, are we going to get a major revision to the downside, or is this right? Is it 3.2%? I'm just curious to know, how did inventories build if imports are down and production is down? I can't solve this one. I just don't know what's going on. Are they fixing the numbers? Did they change the calculation again? I mean, they're known. The government is known for changing the calculation when it comes to everything, particularly inflation and GDP, which gets me to the next point. Again, when you're calculating real GDP, which is what they report, again, the difference between nominal GDP and real GDP is the inflation rate. Well, we're told that there's no inflation. So when you have nominal GDP and then you're subtracting basically a non-number when it comes to inflation, well, you're going to get a higher real GDP. And that's, I think, also part of this equation that we're seeing here, in the first quarter of 2019. Will this continue? Because if you have a build-up in inventory, again, you're going to have that for a couple of reasons, right? You're either anticipating sales growth or you're trying to take advantage of some sort of situation. And you have to remember when we were talking about the fourth quarter of 2018, those GDP numbers, and even the third quarter of GDP, we were talking again about inventories, but this time more in the relation of the U.S.-China trade war and those negotiations, because what were we saying? We were saying, well, you know what, maybe some businesses and purchasing managers out there, they're trying to get ahead of any additional tariffs that might be coming onto the market, and they want to stock up before that happens so they can at least keep the savings or pass along some of the savings to their consumers, or maybe even pass along a price hike to their consumers if they think they can do it and they can pocket the difference for a little while. So there's different strategies at play there. But everything is supposed to be going fine. Everything's rosy and dandy when it comes to the U.S.-China trade talks. And again, we're over there this week, again with another delegation, and we're told, again, by Larry Kudlow and also the Secretary of the Treasury, Steven Mnuchin, that everything is going fine. We're in the final laps, ladies and gentlemen, quote unquote, the final laps. I thought we were in the final laps. It's May, basically, for all intents and purposes. I thought we were in the final laps 2 months ago, back in March. I thought everything was going swimmingly well. I thought it was supposed to be a remarkable, historic deal. I think really what's taking place here is just saving face. How can we look tough, us being the United States? How can we play this as to we're getting something? But what we already know, and this could change, but what we know is we've agreed to give the Chinese until 2025 to get into compliance with whatever it is we're demanding. 2025. Again, even if Donald Trump wins re-election, he will not be the president of the United States in 2025. So what's going on? Is this just a dog and pony show? Is there really some teeth in what's coming out? Because the market's waiting for anything. I think most of this trade deal, or whatever it's going to be called, is already priced into the market. That doesn't mean that the market isn't going to take it and run with it and make all-time highs, perhaps even with the Dow. I mean, who knows what's going to happen? There's probably going to be an initial kick to the upside, and then it's going to be something more of like buy the rumor, sell the fact. Once the thing gets digested, I really don't think this is going to be a phenomenal deal. I don't think it has much to do with trade as it does with a whole host of other issues, national security, all of the intellectual property, the technology transfers. I think it's basically the United States saying to China, an up-and-coming global economic power and potentially military power, cool your heels. Slow down there, boy. You're not going to, just rip us off. You're not just going to sort of extort our companies. Yeah, you got access to 1.4 billion people, a humongous middle class, growing middle class there in China and throughout Asia. If you want to come play ball in China, you got to play by our rules. I mean, look, it's smart on their part if they can get away with it. And they've gotten away with it for a long time. Now you have an administration in there, love them or hate them, that's basically saying, again, slow your roll, cool your heels. That's not how we want to do business. And if you want to continue operating with the United States, some things are going to have to change here. And that's ultimately what this is about. It's not so much about the tariffs and Trump getting up there and hyping them and saying, oh, we're getting so much money into the Treasury from tariffs. Again, you're paying the tariffs, not the Chinese. The Chinese aren't writing a check and saying, here, Donald Trump, put this in the Treasury of the United States of America, billions and billions of dollars. That's not how it works. You're paying higher prices. Okay? Now, how much longer is this going to continue? Well, again, your guess is as good as mine because we thought this thing was going to be wrapped up at the end of March. Well, it's the end of April, and now we're told we're in the final laps. I don't know. I have no idea. Maybe the Chinese are going to fly back to Washington the following week or in 2 weeks. And then, is it going to be back and forth? Is there going to be a signing ceremony between President Xi and President Trump? Eventually, perhaps not. Again, your guess is as good as mine, but that's where we are. But getting back to this GDP number, because this is serious, guys, because this is all playing into everything, because the timing of it is beautiful, because we have the Federal Reserve, the Federal Open Market Committee is meeting this week to make a determination as to what they're going to do with the federal funds rate. What are they going to do with interest rates? Are they going to keep them the same? Is it going to be wait and see? Are they going to say, oh, look how great the economy is at 3.2%? Nobody was expecting that. However, inflation is still extremely low. Now, that's what they're going to run with. That is the narrative that we can expect over the course of the next, oh, who knows, at least this next week, maybe even the next couple months moving forward. That's going to be it. Because when you look at the dual mandate of the Federal Reserve, it has two components, right? We talk about them all the time. It's unemployment, trying to create full employment, and price stability, aka inflation, minimal inflation. Well, we have minimal inflation. So I don't know what the whole thing is with these economists out there saying, well, it needs to be 2%. I don't know where they're pulling this number out of. I do, but I'm not going to say it here. I'm going to keep it family friendly. But they make these numbers up. They pull them out of you-know-where, and they say, oh, that's good. I think 2% is reasonable. And now they're willing to go a little higher than 2% because, well, we've been below 2% for such a while, and now we can, quote-unquote, average it out. We can balance it out. We can tolerate some higher inflation if it's at 2.2, 2.3, 2.4 for a little while. So that's what we're going to see now. Now, the knuckleheads out there, Larry Kudlow being one of them, on the TV circuit, he's out there saying, yeah, it's a blockbuster number, and the Federal Reserve should continue to cut interest rates. Where are they coming up with this stuff? You cut interest rates when you have a weak economy. I thought 3.2% was a strong number, Larry. What are you saying? I mean, does Donald Trump have you going crazy too? I mean, what's going on here? Because it's not making sense. But what's happening here is they've put the Federal Reserve in a very interesting position. Because now the Fed's like, wow, we didn't see this coming. None of their numbers were at 3%. They were all sub 2. I mean, what are they going to do this week? How are they going to spin it? Are they going to say, well, inflation, is that going to be their kicker? Or are they going to say, well, inflation still remains pretty low, and maybe we can continue to cut interest rates. Maybe we can do that. Now, if they cut interest rates, now the whole independence of the Federal Reserve is going to come into question. Again, we don't buy that there's any independence of the Federal Reserve here, but at least for propaganda purposes, from what the White House wants to spin it as and what the central bank, the Federal Reserve, wants to spin it as, they say, well, yeah, they're independent. If the Federal Reserve cuts interest rates, especially if they cut them by 50 basis points, well, then they're doing all the bidding for President Trump and Larry Kudlow, because those two guys have been out saying, yeah, they should cut interest rates. They should cut them immediately by 50 basis points. Again, Herman Cain was in that camp, but Herman Cain has removed his name from consideration to become a member of the Federal Reserve. All those allegations, we talked about that last week. But now you still have Stephen Moore up there, and he's getting attacked and ridiculed. Is he going to bow out? Or if he stays in, is he going to get approved through the Senate? Again, that's going to be an interesting question as well. We're going to stay tuned on that. But what's the Fed going to do? I mean, they could come out and say, well, everything's fantastic. The stock market's making new all-time highs. Everything was fine. 3.2% GDP. Everything's fine. Earnings are good. Larry Kudlow's out there saying everything's fantastic. The President of the United States is out there every day saying everything's fantastic. Oil's starting to come down because President Trump got on the phone and yelled at Saudi Arabia. Everything's fine. So what do you need to cut interest rates for? What do you need to print money for? Those are emergency measures. Those are stimulative measures. I thought everything was fine. You don't need stimulus if everything's fine. You don't need crutches if you can run a marathon. You understand? Very simple. Larry Kudlow and the president are coming out and saying, we can run a marathon, but we need crutches. It doesn't make any sense, does it? So what's the Federal Reserve going to do this week? What's going to happen? I mean, the markets didn't move all that much today. Typically, when you have a Federal Reserve meeting in the week, markets sort of, they're a little hesitant to make a move one way or the other. Again, a total travesty to the notion of free market capitalism, that you're waiting for 12 eggheads around a big table to make a decision that they don't know what the hell they're talking about. I mean, you can't make this stuff up. Then you have Larry Kudlow and President Trump out there tweeting this, that, and the other, and markets move on that. This is beyond the pale. It is. It seriously is. If you understand how markets are supposed to operate and find fair market value, I mean, this is one for the ages, people. This is one for the record books. Write this down. Pay attention. Because if we are in the midst of a melt-up, if the retail investor starts to get into this market at all-time highs, you can bet your bottom dollar what they're going to do. Just a matter of time. They're just going to pull the rug right out from under these people, and they're never going to see what's coming. That's why you have to get people in tune with the Capital News and other shows like it, because they're only seeing one side of the coin. There's the fear of missing out on this rally that has been a blockbuster rally. I mean, you can look at some individual stocks since either late 2018 or early 2019. You have stocks making 40, 50%. I mean, how much more of a melt-up do you want? Because that's typically what you see. Now, obviously, on the broader markets, when you're looking at the S&P, when you're looking at the Dow and the NASDAQ, I mean, we were down 20% in Q4. To come back, you got to make 25%. Well, we're there. So you're back to where you were, and now we're starting to make money. I mean, you guys got to tread very carefully if you're in these markets. You really do. I mean, if you have the stomach for the volatility just to buy something and hold it for the next 30 years, that's a different story. But if you're just trying to make some profits here or there, you better be careful, because this is headline driven. Who knows what the Federal Reserve is going to do? They're somewhat boxed in. You never know what Donald Trump is going to say or tweet out there. We don't know what's going to happen with the U.S.-China trade talks. The can is obviously getting kicked further and further down the road, but we're in the final stages. We're in the final laps. We'll see what happens this week. This week is filled with a lot of information. Getting on to that, we obviously are still in the midst of Q1 earnings season. Well, we had Google, or its parent company Alphabet, report after the bell today. And while they missed on revenues, they did beat on earnings. However, in after-hours trading, Google, again Alphabet, is down 7%. So that's probably going to weigh heavily on the NASDAQ come tomorrow at some point. However, we also have Apple set to report after hours tomorrow on Tuesday, April 30th. So we'll see what happens there. Again, you have to keep in mind, ladies and gentlemen, that this goes back to the fourth quarter of 2018, that Apple came out and gave forward guidance and pretty much said, Q1 isn't going to be good. 2019 might not be, our best year ever. And if you remember, and I remember this, the stock market, the Dow, dropped over 600 points that day when Apple came out and said, yeah, things are going to, they're going to be heading south for us for a little bit. 600 points off the Dow, boom, like that. What happened the next day? Oh, yeah, that's right. That's right. We had it was a good jobs report, and the Federal Reserve came out and pretty much reversed course that day and sort of started to soothe all of those babies having their hissy fits out there. And the market rallied over 800 points the next day. Okay, so you had Apple come out with bad news, the market drops 600 and some points, and then the very next day you have a decent jobs report, and the Federal Reserve comes out and says, okay, here's what we're going to start doing, and the market rallies 800 points. You can't make this stuff up. Go look it up if you don't believe me. I mean, I remember this very vividly because I was so upset that day I just couldn't believe it. I mean, it was one excuse after the other when you were watching the financial mainstream media. I mean, you just can't make this stuff up. That's why it's dangerous to be in this market unless you're diversified, unless you have a plan, because they can pull this thing out from us at any moment because they've increased it by 30% since the end of last year off of nothing but a Federal Reserve doing a 180, ECB doing a 180. The Bank of Japan only knows how to print money, but they're continuing to do it. People's Bank of China, they're on board with all of this, plus their tax cuts. Now you have the Reserve Bank of New Zealand cutting interest rates and saying things are slowing down. But hey, they're going to be printing more money, at least lowering interest rates, or that's going to be the likely outcome. Same thing with the Reserve Bank of Australia. They're now more tilted to the downside, and perhaps they're going to cut interest rates. The same thing with GDP in Canada. And what they're doing with their central banks, again, they thought everything was going to be fine, and then the central bankers came out and said, well, no, it wasn't. We made a mistake. Now they have a bias. We're going to be wait and see, but don't be surprised if they cut interest rates too. And then when you look at South Korean GDP, which came out last week or a week and a half ago, they contracted, folks. First quarter 2019, South Korean GDP minus 0.3%. That's not good, folks. South Korea is sort of a bellwether of global growth and exports. They're a big exporting nation. So they're down. First quarter. What does this mean moving forward? Well, it means that we are in a headline-driven world, which is no surprise, but there is still no bad news. Nothing is knocking these markets down, which is scary as hell, because there isn't any pullback. This isn't anything. This is just, there hasn't been any little 5%, 10% correction, and then let's keep going up. This is just up, 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 up. And that scares the hell out of me personally, because it just tells me that there's some fudging of the numbers going on, because you just don't see this type of action. Again, we talked about some of the legendary investors over the years. They're older now, but they're retiring. They're leaving the game because all of the metrics that they used to look at that have made them billionaires many times over aren't working. They don't make any more sense. This market, I've told you, is completely disjointed and decoupled from so many of the fundamentals. It's frightening. That's why we have these conversations every day. I'm trying to continuously tell you guys what's going on from a fundamental standpoint. The stock market couldn't care less about a lot of the negative data that's coming out. They just cling to anything that looks and sounds positive, and it's off to the races. How much longer can this continue? Your guess is as good as mine. But again, have a plan. Be diversified. Have real estate. Have stocks. Have bonds. Have precious metals. Have cash waiting on the sidelines for when this thing does come down, because it will offer up the sell of a lifetime on whatever companies and corporations are left standing. Believe me when I tell you. You just got to stay calm, stomach the volatility. That's what we're here for. But we're definitely going to continue this conversation tomorrow. It's going to be interesting to see how Apple reports, and if the markets are going to be on edge all day, sort of waiting. Again, you got the Apple reports, you got the FOMC meeting. People are just going to be on pins and needles waiting for their masters to come out and say how good everything is. And then we'll make all-time highs once again. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you. As always, please like, share, subscribe, get the word out. Leave your comments. We would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.